The dot-com bubble is remembered as one of the greatest destructions of wealth in history. But here's what nobody talks about: it built more value than it destroyed. The internet you use every day runs on infrastructure paid for by investors who lost everything. By the end of this video, you'll understand how the dot-com boom laid the physical foundation of the modern internet, why the companies that went bankrupt left behind more lasting value than many that survived, and the surprising pattern behind every transformative technology bubble, and it changes how you see innovation and market crashes. If you were paying attention in the year 2000, or if you've ever read anything about stock market bubbles, you know the story. The NASDAQ index rises from under 1,000 to over 5,000 in just 5 years. Any company with .com in its name triples on its first day of trading. Pets.com becomes famous for its sock puppet mascot and its absurd business model. Day traders quit their jobs to trade stocks from their bedrooms. Everyone is getting rich, and everyone knows it can't last. And then it doesn't. The NASDAQ peaks in March of 2000, and then falls. 78% decline over the next 2.5 years. Trillions of dollars in market capitalization erased. Thousands of companies shut down. The story becomes a punchline: foolish ideas funded by easy money, a cautionary tale about irrational exuberance and the madness of crowds. That is the story everyone remembers. And it is not wrong, exactly. It is just incomplete. Here is what doesn't add up. If the dot-com boom was pure waste and total destruction, why did the internet keep growing faster after the crash than before it? The number of internet users, the amount of data transmitted, the speed of connections, all of them accelerated in the years after the bubble popped, not before. And why did the next wave of companies, Google, Facebook, Amazon, scale so quickly and so cheaply? Where did all that capacity come from, if everything built during the boom was supposedly worthless and had to be torn down? What if the stock crash was just the surface? What if the real story was happening underneath, in cables and buildings and equipment that nobody was watching because everyone was staring at stock charts? The answer isn't in the stock charts. It's in the fiber optic cables buried under every ocean and every highway in America. To understand what the dot-com bubble actually built, you have to look past the websites and the sock puppets, down to the physical layer of the internet. During the late 1990s, telecom companies and internet infrastructure providers went on an unprecedented building spree. They laid 90 million miles of fiber optic cable across the United States, enough to circle the Earth 3,600 times. They built data centers in every major city. They laid undersea cables across the Atlantic and the Pacific. They installed routers, switches, server racks, and peering exchanges. The entire physical backbone of the internet was constructed, at a frantic pace, during those few years. So what does this mean? It means the dot-com bubble wasn't just a stock market mania for pet food delivery and online greeting cards. It was, at bottom, a $1 trillion investment in the physical infrastructure of a brand new technology. The silly websites got all the attention. The cables and the buildings got almost none. The problem was that everyone overestimated how much of that infrastructure would be needed right away. Telecom companies assumed internet traffic would double every 3 or 4 months, forever. They built capacity based on that assumption. And they were wrong, about the timing, anyway. When the bubble popped and the easy money dried up, demand was nowhere near what had been projected. The result was what became known as dark fiber optic cable that had been buried, paid for, and was sitting completely unused. At the trough of the crash, roughly 95% of all the fiber that had been laid was dark. Unlit. Dormant. Investors lost their money. The companies went bankrupt. Shareholders were wiped out. But the fiber was still there, buried under roads and oceans, fully installed, fully paid for, and waiting. The capital had been spent. The losses were real. But the infrastructure didn't vanish just because the stock price did. Here is the part that almost nobody talks about. When the dust settled, the companies that survived, and the new generation of startups that launched after the crash, could buy or lease that dark fiber and those empty data centers for pennies on the dollar. The bankrupt telecoms sold off their infrastructure at fire sale prices. The overbuilt data centers were leased out for almost nothing. All that capacity, which had cost investors hundreds of billions to build, was now available to anyone who could find a use for it, at a fraction of the original cost. Amazon didn't have to lay transcontinental fiber when it built out Amazon Web Services. Google didn't have to build a nationwide data center network from scratch. Facebook didn't have to negotiate access to undersea cables one by one. The capital had already been spent and written off by someone else. The losses of the bubble generation became the cheap infrastructure of the next generation. The internet we use today was mostly built by companies that failed. If the most famous tech bubble in history was actually a massive infrastructure investment dressed up as a stock market mania, what does that mean for how we think about bubbles and innovation? The real insight here isn't about the dot-com bubble, and it isn't about the internet. It's about how transformative technologies actually get built. Every truly transformative technology goes through this same pattern. First, there is a wave of excitement and overinvestment. Capital floods in. Too much infrastructure gets built. Then there is a crash. The bad companies fail. The investors lose their money. Everyone calls it a bubble and says it was all a waste. But underneath, the infrastructure remains. And the next generation of companies, the ones that actually figure out the business model, can build on top of that cheap, already paid for foundation. Railroads in the 19th century followed exactly this path. Multiple railroad bubbles. Multiple crashes. Massive overbuilding of track. And then decades of cheap railroad capacity that powered the entire Industrial Revolution. The investors who lost their money in 1873 built the tracks that carried the American economy for the next 50 years. Electricity in the 1920s followed the same arc. A massive investment boom in power plants and transmission lines. A crash. A shakeout. And then decades of cheap, ubiquitous electricity that transformed every industry. The bubble is how society overinvests in infrastructure for a technology where nobody knows the exact demand yet. The crash clears out the bad business models but leaves the physical foundation for everything that comes after. Destruction on the surface. Construction underneath. You can see this same pattern playing out right now, with artificial intelligence. There is enormous investment flowing into AI infrastructure, data centers, GPU clusters, energy capacity, chip fabrication plants. Hundreds of billions of dollars are being spent on the assumption that demand for AI compute will grow exponentially. There are valuations that look very high. There are business models that don't quite make sense yet. It bears many of the hallmarks of a bubble. And if history is any guide, it probably is a bubble. Most of the specific AI companies will fail. Most of the current valuations will come down. A lot of investors will lose a lot of money. But the infrastructure being built right now, the data centers, the chips, the energy capacity, the fiber, all of it will still be there after the crash. And the companies of the next generation, the ones that figure out what AI is actually useful for, will build on top of all that cheap, already paid for capacity. The question isn't whether there's a bubble. The question is what permanent infrastructure it's leaving behind. The dot-com bubble wasn't just a story of wasted money and stupid ideas. It was a massive, chaotic, inefficient investment in the physical backbone of the internet, and we're all still using the results. The investors lost their money, but society kept the infrastructure. The next time you hear about a technology bubble, don't just look at the stock prices. Don't just look at the silly companies and the misguided business models. Look at what's being built underneath. Because that's the part that lasts. If you want to drift through the full story over 3 hours, the fiber optic race, the data center construction boom, the rise of Amazon and Google, and the hidden pattern behind every technological revolution, in the slow, detailed version made for quiet nights, the link is in the description.